Vaccines picked up speed, but are hitting some bumps. Spring fever and more spending is in the air. All of that is causing markets to continue to defy the pandemic, but diversification still matters. We'll cover that and more today. Welcome to the WealthStep Quarterly Context webinar for the first quarter of 2021. WealthStep is an online financial guide to help people in 401k plans and other individuals make smart decisions about how much money they need to retire and how much to save now and how much to invest now to get there. These webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, and investor behavior patterns to help you stay more relaxed by being more informed and make better decisions towards your goals. Try to keep these to about 15 to 20 minutes, and recordings will be on the blog at wellstep.com. Pass it on to people to help them achieve retirement readiness as well. What is WealthStep? It's all about aim, save, and invest advice, and a little bit of spending guidance as well in terms of what's sustainable. But aim is about figuring out the number you need, your nest egg, your quote-unquote number that you'll need on the day you retire or the day you want to stop working or work less, the amount you'll need to be able to fund your spending for the rest of your life. Saving is pretty obvious, but it's the number that you're going to need to get towards that aim, and investing is related to that as well. The way you save and invest need to be coordinated carefully to hit the right target in terms of that aim number. So first we'll go over some perspective about current topics, and then a quick overview of some recurring typical steps and things to think about. First of all, as a reminder, it's always important to focus on that crossover between what matters and what you can control. There's some things you cannot control, like markets. There's some things you can control, like being disciplined as an investor, and how much you save and how much you spend, and so forth. And all of that should happen in the context of your goals. What's important to you in the short run versus the long run, and what's kind of a wish list versus a must-have in that short and long run. For the last several months, you can see some of the news bits and pieces here that may have moved markets a little bit. In the long run, short-term news doesn't have a lot of impact, but in the short run, it does bump things around, whether it has to do with inflation news or employment or unemployment updates, or the interest rates and Fed rates on and how that impacts the bond and stock markets and so forth. There are a number of things. There's a quick list here. I'm not going to drag you through this right now, but you can come back and reference this. We'll cover some of these things as we go along. At the top of a lot of people's minds still is the COVID situation. It's been getting worse in some parts of the world. It's been getting better in the US, and particularly in a few states like California. But there are still pockets in each state and across the country that still have that the wrong color code, the code you don't want to be in terms of number of case counts and growth in cases. As we've shifted from summer in South America to winter, it's getting a little darker in terms of the colors and case counts there. And as people have relaxed, it's picked up. And in certain areas around the world, even if it's in the northern hemisphere, the same. In terms of overall economic patterns, a couple of key things to see. Unemployment jumped way up when COVID started and has been coming down pretty consistently and pretty rapidly, now hovering at around 6%, which is still considerably above the most normal level, maybe in the US, but especially the last number of years. The inflation levels have been stubbornly low, which might seem like it's a good thing, but if inflation gets too low, that creates a concern where some might wonder if deflation is possible. And there has been talk about, because of the stimulus plans, which have been absolutely huge, the possibility of inflation in the future. One thing a couple things regarding stimulus. The Fed funds rates are still at a rock bottom 0 to 0.25%. That's been, I'll show you a chart later, but that's been at very low levels for a very long time and the longest ever at those low levels. And the Fed has pushed out the likely next increase from 2023, previously projected out to 2024. So trying to be very cautious about not hampering the economic recovery. The Fed has also been purchasing a lot of bonds as a way to stimulate the economy and keep interest rates down, and keeping interest rates down helps reduce borrowing costs, which therefore indirectly stimulates the economy. There was a $1.9, almost $2 trillion stimulus plan that became law earlier this year, and there's an additional $2 trillion proposed, but that may get whittled down as it gets negotiated in Congress. But that 1.9 trillion plus the 2020 stimulus totals almost $5 trillion, which is about 25% of GDP, gross domestic product, and normal. That's way above, way above normal, and that has certain implications in terms of government debt, which has also shot up, and somebody's got to pay off that debt eventually. Although rates are currently low, which makes it a little bit easier to pay off. You can see here again, in terms of those unemployment numbers, the Fed is projecting at the end of 2021 that it'll be around 4.2%. That's a lot lower than the almost 15% level at last April's peak. And there are still over 11 million unreplaced jobs that were lost during COVID. And the pre-pandemic levels of employment are not expected to be really back to normal until 2024. This has caused a little bit of a shrinking in the middle class, and that is really the spending class, which is the engine for the economy, because about 70% of spending or the GDP is from consumer spending. And consumer spending and confidence is actually up a little bit. You can see the confidence number here, partly helped by those big stimulus checks and the big stimulus plan that went out. So that's a little boost there. The question is, will enough jobs happen in time for those stimulus dollars to kind of smooth over into regular income? And in terms of more on GDP, it was revised upwards to a real 4.3 in terms of the fourth quarter number, annualized from 2.8. So the economy's been improving a little more rapidly than expected, and that's after the second quarter of 2020 being a negative 31% annualized, just huge. And then in Q3, 2020 was a big bounce back of 33%, so that was a huge upside, but that didn't actually fully offset that second quarter. And there's a Wall Street Journal survey that says that expects that about GDP will be about 6% for 2021, and the Fed is projecting about 6.5%, so roughly in that same range. But the Fed is also projecting a long, slow recovery after that through 2025 with below average GDP. So some of that boost is coming from the stimulus that isn't expected to stick around. So it could be things are expected to slow down a bit before things get truly back to normal. And those projected numbers of 6.5 and 6% of GDP include the 1.5% amount that comes from that stimulus, some of those stimulus dollars. This is what sort of a general graph of the different stages of the business cycle. Still in a recession stage, although there's, depending on the shape of how things go in GDP, maybe we're starting to crawl out of that now. Still maybe a little too soon to tell, but this is just the general pattern. And here is that chart of rates mentioned a moment ago, where you can see normally rates have been hovering closer to somewhere in the 2.5 to 5% range, more on average, with periods considerably higher that in the 70s and early 80s. But more recently, hovering right at or above zero, ratcheted up as things were improving after the global financial crisis, and then brought right back down to essentially zero with COVID, and is expected to hover there for a couple of years. That is, again, it's unusual. This is part of that overall stimulus, and it's not normal. And when rates start going up, and the Fed will want to raise rates so they have more dry powder to lower rates to stimulate the economy in the future, that tends to cause negative bond returns and can put a little bit of damper on the economy as well as stock returns. So it's an important tool, but there's two sides to that sword. In terms of what markets did, the expected inflation and the related recent rise in rates, a little bit, not the Fed rising rates, but the market in response to expected inflation in the future, led bonds to be negative for the quarter across most bond categories. Stocks were positive in the 2 to 6% range. But look at this. For the 1-year numbers, this is incredible. There's been a few 1-year numbers like this in the last 10 years, but this is just really, really strong, much higher than normal. A normal projected long-term return for stocks is closer to the 7% range now, with historical numbers around 8%, maybe a little higher than that. But last year was 62, 45, 58, depending on whether it was the US market, foreign, or emerging. So enjoy that while it's there. That's not normal. That you won't see that very often. This is the 4 worst markets in history. If we especially combine the global financial crisis in blue and tack on the COVID market, which really wasn't long enough to be one of the worst markets. But if we tack those on to each other, and this is after inflation, you can see the COVID and global financial crisis market has actually had a much stronger recovery than the others. If you don't adjust for inflation, the 70s market, because that high inflation period was would stand above here down on this lower chart. This is just a good reminder. It's normal for markets to have significant drops sometimes. It felt like in the global financial crisis, it was going to take forever for that to come back. COVID was a rapid snapback, and other markets it can take a while. And that'll happen again at some point in the future. So you just want to make sure you're invested on a diversified basis, appropriate for your life stage, and then stick with it. Don't try and guess what's going to happen. On that note, a lot of people are surprised that stocks have done as well as they have. Diversified portfolios have benefited from some of these numbers here. The 10-year numbers in large company stocks in the 11 to 16 or 17% range. That is, again, this is almost more than twice the long-term average of return. So don't expect that to be normal. But in some of those large stocks are the big tech stocks in the growth sector, Facebook, Amazon, Netflix, Apple, and so forth, who really had a strong run. But more recently, it's the value stocks that are getting some of their comeback. And amazingly, if we look at the stock market since the low in 2020, look at these numbers on a cumulative basis, basically from 80 to 130%. So a great reminder that you cannot predict when markets will go up, when they'll go down, how fast and long they will go up. You just don't want to miss out when they do. So invest and stay disciplined, find the right mix for your life stage, and stick with it until your life stage changes. On a similar note, those, or related anyway, those large cap growth stocks are primarily reside in the S&P 500 and are all of the largest stocks in the S&P 500 are dominated by those tech stocks. Here's the top 10, most of which are tech, and then a few of which are financials and product companies. But again, the top ones are big tech companies. And those 10 companies represent 27% of the overall index, which is just 10 stocks out of 500 represent 27% of the market capitalization of the index. That's big. It's never been like that before. You can see this chart that the top 10 as percentage of the index has ratcheted up to its highest level recently. So that means that the S&P 500 is a bit more of a tech kind of index than a broad market index in some ways, although that overstating that a bit, but at least more than in the past. And here's a chart, speaking of the top 10, not only a chart, but it's a video. We're going to show, you're going to see how the top 10, you can see here 20 years ago, Exxon was the largest company, and you'll see how things change. You see all kinds of different companies here, but let's take a look and see what happens. Here you can see at the beginning, IBM was one of the big kind of quasi-tech, but really more of a manufacturing company. Exxon, energy company, second biggest, keeps growing. GE, you may know how small GE is now. AT&T, not really tech. There goes IBM. Whoa, whoa, IBM, where'd you go? Bye-bye, IBM. General Electric and Exxon. And what about Coca-Cola? That's in the top 10? Hard to imagine that right now. And look, there's Intel, tech company, Microsoft creeping their way up. Up, Intel's up, and then Intel's down. Cisco's in there now. Look at Pfizer. Pfizer, Citigroup. Look how much these things bounce around. These are the top 10. They don't stay the same. You cannot predict what's going to happen when. But pretty soon here, you're going to see some of the more current ones hop in, like Google. Look, Google's up, down. Google's out. Wait a minute. Oh, Google's back. And Apple. Look at Apple jump up. Now Apple's in a race with Exxon. And Apple's in the lead now. But wait a minute. Who's coming back? Now Google's getting bigger. And Exxon, look at that yellow line. Down. Bye-bye, Exxon. Getting close. Shrinking, shrinking, and goodbye, Exxon, as Apple and Microsoft and Amazon and Google and Facebook dominate the top 5. So this is a pretty interesting illustration of how things change. So if you're enamored by some particular stocks, don't expect them to stay there forever. You still want to be diversified. Diversification still matters. You know, for example, here in this lower right chart, U.S. stocks have outperformed international for a while, but before that, international had strong outperformance. And there are periods, more periods than not, for a number of years when international stocks were stronger than U.S. stocks on average. So just don't expect any particular pattern to keep going the same way. Then there's the bond yield curve. This may sound a little technical, but this shows the different bond interest rates at a certain date along the what's called the maturity spectrum. So you have 1-year bonds, 5-year bonds, 10-year, 30-year, and it's called the yield curve because it shows the shape of a curve, different interest rates as you go out to different bond maturities. And the bond curve inverted about a year ago or so, and is now back to normal. An inverted yield curve, actually it was more than a year ago, generally indicates a recessionary environment might be on the horizon, and low yield curves like this. This is low relative. For example, this is where we are now relative to the last 10 years. When it's in this lower range, it tends to imply a slower growth economy. So just interesting to see where rates are and how they're changing and what that's trying to tell about the market. Another thing regarding bonds and rates is a measure called duration. And when you have a portfolio that has a mix of bonds with a given interest rate, Fed interest rate increase, say for example of 1%, if the duration of the portfolio is, say for example 4 or 5%, a 1% increase in rates would suggest a 5% drop in return in the short run. Now, it's not very common to have a 1% increase all at one time. It would tend to happen in 0.25% increases, maybe a little more, maybe a little less. And in the long run, this chart here shows over the last 20 years that there are very few full years where bonds were negative, but it can happen. So just a reminder that bond risk exists as well. So let's talk about some of the high-level recurring concepts. If you've already seen this presentation before, you might want to just stop here, or you can get a good little refresher. And for an even bigger refresher, go to the WealthStep.com blog and see the video at the top, it's pegged at the top of that blog, which is a general investor financial literacy education video. So cover some of these topics here. But to give a very high-level summary, the key things are aim, save, and invest. If you want to become financially independent and retirement ready, you need to know when you plan to retire and how much you're going to need. So WealthStep is designed to help you figure that out. Most people should be saving 10 to 15% of their savings. If you're the younger you are, and the earlier you start, you might be able to considerably save less than that. If you're considerably older, then you might need to save a lot more than this to get where you need to go. But you need to run that math, and Wellstep can help you do that to figure out how much you should be saving now to achieve those goals. And then the investments is not unimportant, but it's really the aim and the save that will help you the most. And then you need to invest wisely, basically by life stage, and you shouldn't be messing around, guessing with the portfolio, changing it very often. You should really only have 3 or 4 portfolios over the course of your whole life and changing accordingly. And if you have a target date fund, then you can just use that one fund because it will automatically change the stock bond mix for you as you approach your retirement years. Here's some of the comments that we hear when we do 401k education meetings. People in their 20s and 30s say, hey, I don't need to do it now, I'll take care of it later. Then people in the 40s say, wait a minute, retirement's not that far off, I better get going. But they don't always get going as much as they should. And then once people get in their 50s and 60s, say, oh, I wish I'd started saving sooner. I really could have. It would have been a lot easier. And people in the 70s who didn't save enough say, I wish I could stop working, because oftentimes they don't have enough. People saying that might not have enough to fully retire. And Social Security is usually not enough to cover it. So you can learn from other people's experiences. Also, as a general perspective, I mentioned earlier that stocks have a projected 7% return here for the next 10 years, roughly. The long-term return is closer to 8, 9, or really closer to 9 or 10, depending on the time period, but gives you a sense that the economy is a little slower than it has been in the past, and that suggests lower average return. So you want to have reasonable expectations about what returns will do. And bonds, for example, projections are pretty low, especially compared to inflation, and even now updated inflation bond returns suggest that there could be a negative return in bonds, given that inflation, the bond projected numbers are coming down, given that rates have come so far down and have therefore then more room to go back up, which hurts bond prices and returns. But in the long run, even if it's bumpy to be in stocks, it's important to have enough exposure for your life stage. If it's bumpy, but it's still bumpy on an upward trend, these are small cap and large cap. And bonds, less volatile, but a lot more boring and don't do as much work for you, are better as a cushion than a return generator. So more of a cushion when the stock market gets volatile. And inflation is no joke. It's a big risk in the long run, even if it's low right now and low in general. If you do nothing and you just have $1 and you stay here, you actually are losing a lot of money relative in purchasing power relative to inflation. So you want to invest wisely so you have more money to spend in the future, but also at a bare minimum so that you're beating inflation. And if you just match inflation, you'd have to have all the money you need right now to spend in retirement. But most people don't have that money now. That's why they need to grow it through investing. And just as a reminder, there's a lot of people miss out on market returns, not because they don't invest, but because they get in and out of the market because they're maybe afraid or concerned or scared. And that leads to something called the behavior gap, where the average investor return is about 4%, the average stock market return is about 8%. And so over 20 years, that can lead to some huge numbers. So just doing nothing and being in the market generally will lead to a pretty solid return. You just have to be disciplined and stick with it. So once you're on Wellstep, you can go to the Advice Center. There's the Planning and Saving Advice module. That's the place to start, number 1 here. Then you would use the investment advice. This is basic and generally driven, helping you figure out what's appropriate for your life stage. There's that educational video mentioned a moment ago. Then you would implement that advice, whether it's in your 401k plan or your own outside account. And there are additional resources to learn from, including on the blog and social media, to keep you receiving tips and helpful things to keep you on track to be a wise investor. And there are multiple ways to access WealthStep through a 401k plan, if your 401k plan offers it, through WealthStep Direct, which has the, and all 3 of these at the top have the basic plus advanced version of the advice. There's WealthStep Digital, which is no portfolio management if you're on your own outside of a 401k or not needing a portfolio yourself to be managed. you get just the digital advice for the basic planning, and then the general public can access the basic level of advice for free, and that's our attempt to help the average person at least get generally on track. So again, key things are aim, save, invest, spend within your limits and means, and make sure you are aware of what the most important risks are, which are really inflation, and making sure you are prepared for a long life, which means having enough money to spend during those years. So thank you for joining us today, and we look forward to seeing you next time. Thank you. Bye-bye.